And we're live. We're back this week in Coverager. It seems like every time I close my eyes on a Friday, it's the next Friday. So the week of August 28th, the week ending August 28th, I am, as you can tell from my view, I am in podcasting headquarters in Naples, Florida, survived Hurricane Laura. And in Coverager headquarters in New York City, we have both Sheffy and Avi. Good morning.
Good morning.
Good morning.
So this is the podcast where we discuss topics of the week, things that were on Coverager or news items that were of particular interest, and Sheffy, Avi, and myself digest them and give you our views. And so I'll kick it over to Avi, who will talk about topic number one.
Thank you. So the biggest topic by far in terms of clicks, Revolut wants to create an insurtech business. They specifically mentioned in the job board insurtech, so people don't get confused. A big story, of course, not surprising. They have over 10 million customers in different parts of the world. They're losing money. Like most fintechs, I would say, lose money because when you offer fee-free banking, then your revenues are kind of minimized. And we recently did a report about fintech in general. It's such a natural synergy with insurance. And people, they fear, I mean, they used to talk about, oh, when Google is entering insurance and Amazon is entering insurance, and yeah, Google will talk later about their entrance into insurance. Fintechs are a way bigger threat for the simple fact that they have data that both Google and Amazon do not have. They know how much you're paying for car insurance. They know how much you drive based on how much you fill up your tank. And they could tell you, hey, Nick, we saw that last month you paid $140 for car insurance. We think we could get you a better deal. That resonates because it's relevant, there's context, and why not do it? So yeah, it's a very interesting story, and looking forward to hearing your thoughts.
So the commentary that didn't make the email or the newsletter was, so side story, I was speaking to an individual that is going to launch a startup, and one of the things that he was most fascinated by was his ability to shorten the application process for small business. And somehow that got me thinking how fintech, it's all about knowing your customer, and insurtech, you haven't solved for the fact that most people still don't know what they're buying. And that's sometimes it's on the customer. It's not always on the actually, the broker or the carrier. But there is an issue here because we're talking about instant and fast quote. And what Avi's basically saying is here are companies that actually do know really important aspects of the customer. Right. So it makes sense for Revolut to enter the insurtech space again because they're not profitable in one area and they can be profitable in a different area. And I think that if there are naysayers about the whole fintech insurtech synergy, is because they have some reference of a bank assurance model that didn't work. Now, I know insurance has borders, and I know that our strength is analyzing what is happening in the US. Clearly, in India, bank insurance is a really big deal. Here when I think about, early 20s, how I looked at bank insurance, I think of Wells Fargo selling insurance products, and that to me is isn't a positive, but that's different. The past is the past. The present is different. These are different players. These are players that consumers talk about, go to for their financial product. So, obviously one to watch. And another commentary when I was reading, when Avi was the one that picked up the story, and it was Sunday, so I didn't talk to my brother on Sunday, but I saw the story, and I was thinking to myself, because it got so many hits. My comment was like, I was like, oh gosh, maybe you've picked the wrong avenue, Shafi, because if you would have went to fintech, just judging by the interest that this article had compared to all the other insurtech articles, and if that doesn't tell you something about the consumer sentiment. By the way, I don't know these people, right? Because if typically we reach directors and executives, the folks from Revolut were all over, and Avi was like, who are these people? And I'm like, I don't know. They're consumers. That's the thing. That's the beauty of it. But just measuring by the amount of clicks. But anyway, we're sticking to InsurTech.
Um, my first comment is, as Avi was describing it, I'm like, that feels creepy. So they have that advantage, right? They can comb through your credit card statements and use predictive models to basically say, okay, they're spending this much on gas. They can make decisions about who you are. They have your credit rating. So you're right, Avi. They have a lot of information going into what would be traditionally the application process for an insurance company. It's likely in a lot of those cases they would know enough that they could get a quote. Like they could just say, this is the price we think we can save you right now. Press this button and lock this in. That is a huge advantage. And Sheffy, to your point, as Avi was describing this particular entry, all I kept thinking about was Citibank and Travelers, and what a fiasco that was. And so I think it's like everything that we discuss week after week. It just boils down to execution. It's what are you trying to accomplish? If you're just trying to make a quick buck, it's probably not going to work. If you're actually trying to deliver value and you have a passion and a mission to solve that problem, you'll figure out a way to do it. So there's definitely advantages, but I can also see them tripping over themselves and not executing correctly because it's almost too easy. As there's just so much information. It could be almost too easy, and they trip over themselves just trying to make a quick buck. So,
However, so this is
yes,
the other side of this, right? Because what tends to happen is that, the fintech giants typically attract the incumbents. So if they get a strong insurance partner on their side, and I'm sure people will line up to
yeah,
work with Revolut because of the insights to consumers that they have. And you are already seeing where there is a digital insurer in Greek, right, saying, hey, you get a Revolut account, I'll give you $10. Do you buy home insurance from me? There's all sorts of these partnerships that you can create, right? So it boils down to execution and creative, to your point. But
yeah.
if they can secure a strong insurer by their side, then why should they trip over themselves? I hope
I
they don't,
think
right? But I think, but to your point,
Mhm.
right? There's Travelers and Wells Fargo behind, that we're thinking about, and
so.
different people.
These models, and I mean the owner of Travelers and then Citibank, they made a lot of money, so I'm sure they're happy. But that's a manual process. Like you're dependent on the banker to mention, "Hey, Nick, we offer insurance. We can help you," and that to me, like you really need to kind of have like robots, everybody on repeat say it for it to reach the potential. But with fintech, that's not the case. And I think, for example, if like to me, Revolut doesn't have to work with one company. They need a model like Gabby, like Jerry, even Policy Genius to say we have the data. Let's see who we want to target. We know this person is a homeowner and they have a car. Let's put our efforts there. We know this customer is price sensitive because he's cheap and he doesn't buy coffee. So we know they will care about price, and they can do things that others cannot. And I think it's a huge advantage. And again, I would pursue the model of Gabby or Jerry. I don't think there's like one of the most successful insurtech companies out there is not instant. It's over the phone. It's Policy Genius. Gabby is over the phone. You can't buy immediately on Gabby online. You put in your information, you get a few rates. They have to make sure everything is correct. Then they approve. So it's not instant, but
So
it's
it's Cover,
working.
right? So it's
So
Cover,
it's
and
cover
before
over the phone.
COVID.
Most of it, yeah. Even Metromile, a lot of it is over the phone because people don't understand what they're buying and they have a lot of bugs. But uh, it's not about instant.
He let that
Consumers,
slide.
yeah, but the thing is, consumers, we talked about this years ago. There's convenience and there's price. Convenience doesn't shine when you don't do it often. Like Nick, if I would pay you and say, "Hey, give up your laundry machine, wash your clothes by hand," you say, "You crazy? I'm not doing it," because you do it a lot. But for insurance, you tell someone to wait 24 hours or to hop on a quick call, maybe if they need to. Sure, if every 6 months I'll hear for you next, and there's the advantage of fintechs. and this is a model that's been done in France. They want to be the broker of record for their users. We'll monitor your insurance. We'll see if there's better rates, better coverages. They'll know when you buy, baby stuff, and they'll know, okay, the time for life insurance is probably now. So customer acquisition cost, it's a dream come true, and data is a dream come true. So I think it's going to be a big deal. And, it depends on the execution. Like, again, if Revolut ties themselves to one insurer, that's going to be a big mistake.
So isn't that ClearCover's model to locate or discover life-changing or life-affecting events like, oh, you're getting married.
That's
this is a good moment to, sell
Their
you.
theory, but the problem is that they don't control those interactions. Like, they have to go and tell a platform that has the data, let's work together. Revolut is coming and saying, I have that. Who wants to work with me? So ClearCover, that's their, and everybody wants, to be relevant. That's the idea. When you're relevant, then you reduce your customer acquisition costs, you increase conversion rates because, it's relevant. But we always said those that own the platform, those that owns these interactions, they're going to be successful, and, they could. It's just natural because don't forget, like, if you look at Chime in the US, their whole concept is financial wellness. We won't take fees, so you'll have more money at the end of the day. So for them to help people save money on insurance, that's part of their mission.
Sure.
Of course, it's part of the way to make money. They need the money, but it's inevitable, and it's going to be very big. Once the first company that gets it right, the model, others will follow, and I feel like companies like Cover and even Policy Genius that has great organic rankings, they're going to struggle because these fintechs are going to prevent people from even searching for insurance because they know everything is in the app, accessible, and available.
So it'll be interesting to see. So I don't think anyone would deny that Revolut would have somewhat of a data advantage. It's a different set of data, but with the right predictive modeling, they could really uncover a lot of stuff. But now what I think it'd be really difficult to sort of deny as well that it's another competitor coming in, potentially another model of customer acquisition. And so just can't help but think more shrinking margins, right? Price is going to keep going down. Like, it's going to be harder and harder to earn an underwriting dollar in auto. It's just going to be so freaking competitive all over the place. And obviously with Revolut, it's not just auto, but I don't think a lot of the insurtechs that are in the business focus a lot of their attention on the margins and just like how crowded it is, how difficult it's going to be to differentiate yourself. I just keep going back to that because it's like, if you have trouble standing out and you don't have some sort of unique advantage, you won't even be able to survive. Like, you're just going to languish in mediocrity for a while. It's, in these auto homeowners, man, it's getting crowded.
Yeah.
No one will deny that there's going to be a lot more insurance shopping in the future.
As people get younger, I mean, you look at the demographic of who uses, a fintech app, and mostly young people that don't have much money and a few investors that invested in these companies, but I'm sure they have their Wells Fargo and Chase account on the side. But these are the modern consumers that everybody's talking about, the struggle for insurance companies to reach those consumers. And, it's really interesting because, as you said, like, it's going to be about price, and then insurance companies will know, like, okay, I'm on Revolut, I'm on Chime, I'm on Starling Bank. I need to have the best price to win. That's how I will probably win. And as you said, the margins will go down, but it's going to take out a lot of middlemen like insurtechs because they can't afford to lose money. I mean, they rely on the commission. So it would be interesting. I mean, if I was really Revolut with the money that they have, I would just look at acquiring, because they won't be able to do it online. No way that they will be able to do it online, completely on. I don't care about what technology they have. It's not up to them. It's up to the insurance companies. Are they willing to work? And if again they will come and show 2-3 options, that's not going to cut it.
Yeah.
So that's why they'll need phone support. They'll need people, and a lot of it goes against their model. Like Revolut is digital only. Like people still complain about trying to reach their customer service. So will they go out of their way to do this?
Or they will pick the products, the easy products that it's both like there's elements of convenience and confidence, right? There's a reason why we're not seeing Policy Genius play in the auto insurance space.
Yeah.
So it doesn't necessarily mean that they have to go directly to that product.
Sure.
I mean,
Auto is so big. Auto insurance is what, 280 billion, right? Or something like that. Like just a ridiculously big number that they only need a small market share for it to make it completely worthwhile for them.
Like I would do, if that's the case, then I would present the options. And when Geico is not there, I'm going to leave kind of like a text box and say, Geico does not want to give their price because they want you to call them and try to convince you to buy. So it's up to you. That's why they're not here. And maybe then you could say, you know what, I'm forgetting about Geico or State Farm. And that, like Travelers is the most competitive on Gabby and Jerry, at least in my case. So I went with Travelers. Who would have thought? As Travelers for car. I mean, for me, it's the first time with a car. So who would have thought? But that's going to be the game. And again, if you do go online, you'll have to kind of have a sophisticated approach. If you're willing to have that phone support, and I know some of them do not want that because they want to be digital, but you need to get dirty to get insurance to work. And you look at Policy Genius, they have a lot of salespeople.
Yeah.
And support. So
it just it sounds like for those that are listening, the strategy of how like we're well beyond the tech, right? It's tech is just a piece. Well, one thing, fintech and insurtech are like merging, right? It's going to happen. We knew it was going to happen. There's a lot of synergy there. So I don't know what we're going to call it. FinSurTech.
We're going to call it fintech. That's what it's going to be called.
I'm playing around. But I think more importantly, it gets to strategy, right? So what is your product, but what is your go-to-market strategy? So I just can't help but circle back to like a branch where branch could counter move, right? Or counter market with, well, we can save you on the whole bundle, right? So auto, homeowners, umbrella. There was one other thing that they did, but anyways, so we can save you on the bundle, right? And they can target a different kind of audience, and it's a much more complex sale that a Revolut would really struggle, I think, trying to compete with that. There's a convenience in getting the bundle, and then also Hippo, which is the whole laser beam focus on the homeowner with the warranties, with the smart homes. Again, that Revolut strategy wouldn't probably work against the type of customers Hippo is going after. So I think it's really critical for the leaders of these companies as they think about not only their technology, but how it gets positioned and what's the overall strategy, because there's not going to be a winner take all. And so they just have to decide who are we going after, and let's build an entire framework, marketing, product, everything around that particular customer segment.
Now keep in mind that it's going to get really messy when Chase and Citibank decide to take similar approaches, and they've been copying fintechs. Like if you now go to the Chase app, amazing what you can do, budgeting and set money aside, like things that a year ago you could not do, and who would have thought. So once they go into insurance, and they obviously reach a very different customer base that has different needs, they are going to get it right. And again, as you said, for those sophisticated customers that branch targets and Hippo, they would be very happy to, again, wait 24 hours, be on the phone if needed, once every 6 months, once a year. So then it's going to, again, be a big problem. And, we're talking about distribution. Like insurance is, people think it's about technology, customer experience. It's not. You need to get a client first, then to sell all the other stuff. It's about distribution, and these companies have the better data. And again, they live on your phone. Like Chase can send you a notification saying, Nick, it's time. It's that bad time of the year. You need to look at your insurance. Yeah. But, but that's what it is. And it's funny because when we used to do with Google and Facebook, and advertisers would go after them because Google said, oh, people come to search here. And Facebook said, well, we'll tell you what they like, if they like tacos or pizza, and if they're part of this group or that group. But let me ask you this. What's the most, compelling data for insurance? Financial data. And that's what it is. Like, that's what really moves the customer, because at the end of the day, insurance is insurance. It doesn't matter if you like tacos or pizza, you need insurance. But if I know how much money you have in the bank, if I know how often you switch insurers, they have the history saying that a year ago they were Travelers, before that they were Progressive, so they like to switch. That's a big deal. And at the end of the day, they have no choice. Like, we saw the report of Citibank saying how fintechs are going to shrink revenue for traditional banks because no fees. Like Discover eliminated their fees because of the whole no fee movement. So they said, while you'll see a reduction there, you'll have to create other products to try to make up for it. So they're going to do that because they don't want to give up their money.
Yeah. Any last comments on Revolut, Sheffy? No?
We said it all.
Okay. Let's not beat a dead horse then. And this will be a topic that comes up often, I think, both the fintech and Revolut. So we'll keep an eye on that. And
it just from an insurance employment standpoint, if it means you may have a better career path, then go for it. Let's not forget the insurance professionals that have a shot at working at Revolut, although I think their culture is a little bit problematic, but it's a stepping stone to other companies.
Okay, so let's keep beating this dead horse then. Let's not transition the topic.
If I was an insurance professional, if I was an insurance professional, I would reach out to these fintech companies and say, let's build an insurance unit.
Let's expand it beyond an insurance professional. Let's expand it to some, county podunk mutual in the middle of the country. This is an opportunity for them. This is an opportunity for them to look at the advantage that they have. They have paper. They can issue a policy in a particular state. They have an entire back office system. They have reinsurance. The likely thing that they're missing is that they can't differentiate their product anymore, right? And they struggle with distribution, right? The product almost is irrelevant if they can get the distribution. So this is an opportunity not only for insurance professionals for a career, but these companies that have been languishing and have plateaued decades ago and are just basically on life support right now, just waiting to merge with some other company in the next 10 years. This is an opportunity for them to think outside the box a little bit and maybe partner with one of these fintechs and, allow their assets to be used. You have a license in a state, issue a policy, we pay claims, right?
Right.
You can white label your product and make it available to one of these modern, let's call it a fintech, but it doesn't have to be fintech. It could be Google or Amazon or whatever, and just say, hey, you want to write in Illinois? You want to write homeowners or auto in Illinois? We have a license that will allow you to do that. No one even needs to know. It's saying like in fine print, insurance backed by Podunk Mutual or something.
This is a super solid point, simply because, I barely wrote about Spinnaker Insurance, still Hippo partnered with them, right? So you've got a lot of mutuals that sometimes they don't even have a newsroom page or a PR page that you can track in order to see what has changed with the company. So there's definitely an opportunity for these companies to shine.
Yeah,
they have the basic necessities for Revolut to offer insurance.
Yeah, be the enabler.
Yeah.
I'm not going to name names, right? I'm not going to pick on any of them, but there are, I'm from the Northeast. So in New England, there are mutuals everywhere. there are small towns with a population of 10,000 that have a mutual in there, and those mutuals can never bust out of that little bubble, right? Because it's like, if you know, I'm not going to name a mutual, but I'm just going to pick a town. Athol Mutual, Athol, Massachusetts, Athol Mutual. I don't think one exists, but like they can't do much. There's no branding opportunity for them. But if they have 100 years of history and a license and an A rating from AM Best, and they can do auto or homeowners or something like that, they have an asset that's just sitting there not getting any value from that. They can make that asset available to a third party that can then pretty much deliver a ton of business to them. And all they have to do is reach out and think outside the box. I know it's really difficult, but I'm kind of sticking to my guns here. I see these assets and it's like, what are you doing? Even Spinnaker. So Spinnaker gets purchased by Hippo, and Spinnaker sort of struggled. Spinnaker, Spinnaker was traditionally like a fronting company. So their business model was, you can use our license, and as long as you bring reinsurance to the table, so we're not taking any risk, we'll, carve off a 5 or 7 or 10% commission for the privilege of doing that. It's like, why the mutuals could do that? Like there's just so many opportunities to have a Hippo or a Kin or someone like that wants to expand into a new state. You should make your paper available to them. It just creates so many more opportunities to partner up and create a new distribution opportunity for yourself.
Yeah, and that's where I think State National stands out. I think they
completely.
They took that approach, and but the problem is with that model. I mean, not with fintech, but with State National, is you'll only be as big as your partners. And I feel like when you get to a place where you grow to be really big, then you start to say, well, do I need State National now? Like, I'm big, I'm powerful. Maybe I could, bring it in-house. But that's a problem. But it's a great place to be in.
But you know what? That's a really good point. It's hard to give it full coverage, but we are seeing insurtechs that are swapping underwriters along the way. So it's not that big press release where they're coming out and saying, "Hey, this is the insurer that we're partnering with." It happens quietly after a while, and you never know if there's some blaming going around or what happened, if it's in a positive or a negative context. But it's happening.
Well, and when James River resigned from the Uber account. Right. It was, we can't have these losses going on indefinitely. And so there's probably an underwriting opinion that it's like, they're not going to be able to get their losses under control. Like, we can't make this profitable because they can't. So it goes both ways, right, Sheffy? Like, it would be if someone partnered with a fintech, the issue with the underlying carrier that's partnering with them is like, will you actually make us money? Or you're just going to sign up everybody. It's the false positive effect. Distribution is only concerned about the transaction. They will sign up anybody. If you have,
and there's another point to that, right? They will sign up anybody, but you have to always remember who has more control, and sometimes it's the one with the distribution. Sure. So I'm not going to name names, right? But what we've learned this week is that there is a big consumer-facing giant that is working with a life insurer in the distribution space, but they have no problem shopping around for different life insurance partners to see if they can earn an extra revenue, right? Earn an extra buck once a consumer signs up with life insurance. And sometimes from our perspective, so I think between Avi and I'm probably the one with more emotions and passion, but I was a little bit disappointed because you did go and put out press releases promoting a partnership, but you have no problem doing something in the back end that probably the other side doesn't know. So to Avi's point and to your point, you're constantly on your toes. You constantly need to make sure that the partner that decided to partner with you last year wants to partner with you this year, because this isn't a Catholic marriage.
And I think VCs have like a big role to play here because, some of them invested in both insurtech and fintech, and obviously they could make the connection, or maybe they're working on it. But the distribution is going to get solved. Right now, it's a big mess. It's going to, kind of be in order. And as you said, Nick, do you want to be the enabler? There's no shame in saying enough is enough. Like, let me do something different. Let me help this company. And there's too many middlemen with insurance right now. And if consumers really want to save money, if that's the goal, then you have to cut back some of the middlemen and go with
Exactly.
that. Yeah.
I mean, Avi, they've been saying that for decades. There's too many middlemen in the transaction.
Yeah.
It's a complex transaction, and so
And imagine how much money Google is going to lose. Google and Facebook are going to lose out of this, of fintechs becoming more dominant insurance players, because again, no need to go and search and pay for expensive
different
keywords.
model though. Like, so I think it gets back to, I don't think there's going to be a winner take all. I think a lot of these strategies can be very successful. But there will not be
No,
Google
yeah.
of insurance. Like, there will not be someone who's going to take like 50% market share. It's literally impossible.
Yeah.
And you try to have a conversation with someone describing this, and it's so difficult to overcome their inability to view all of these other industries where there are winner take alls, and it's predominantly tech, and they can't quite seem to fathom that. Well, why wouldn't tech have the same effect in insurance? With the single big problem that insurance is a leveraged product. You're paying a small amount of premium for a potentially gigantic payoff if something bad happens. If you add up all of those bad payoffs, there's not enough money in the world to pay them off. That's like my day-to-day catastrophe insurance. Like, there's even Berkshire Hathaway that has $200 or $300 billion of assets. A large Category 5 hurricane that makes landfall in Florida is easily $100 billion event. That's like, it could not destroy the company, but it would be a balance sheet affecting event for someone like Berkshire Hathaway if they had that sort of exposure. It can't be winner take all. The exposure is too big. The product is leveraged.
InsurTech has introduced this kind of they're trying to make a happy world out of insurance. We're talking about delighting the customers and trying to always pay claims as much as possible, right? The whole fairness and convenience, right? All those fun stuffs, but nobody's talking about the other side. And the other side is that not all carriers care about retention. So some people would want to have a customer with them for 2 or 3 years, because to them there's going to be a claim happening, and let me get the client before the claim comes. There are different aspects of the business, right? For underwriters, for instance, do we really want to write the risk, right? So they have this authority and responsibility to make sure that the book is clean. So different segments within the insurance business have different goals, and these goals sometimes don't align. But the overall messaging of InsurTech is that we're the better part of insurance. Sometimes it's exactly the same.
I can't even overestimate how important what you just said is. There's so many different areas. So Avi, when you were talking, so there's that conflict. What drives? Who has the leverage, the distribution, or the capacity in these
distribution?
relationships?
It
depends on what Sheffy said. It depends on what you're trying to do. I can tell you. So I was in a business meeting last week where we had this philosophical discussion, right? Where the one side was distribution can really dominate and kind of have the upper hand in it. But I think there's a line where, especially in my field, which is catastrophe insurance, I disagree. I think for enduring value, capacity controls it has the upper hand. If you if you're just selling stuff and you're creating these gigantic losses, you're not going to have capacity. You won't be able to create any enduring value. You have to show that you can keep the losses under control. Whereas I think on like auto and things like that, distribution, it swings over to the distribution side because you won't have those massive event losses. It's much more transactional. There's a lot of friction in the process. So convenience and reducing that friction can carry the day. But I think to Sheffy's point, it really depends on what are you trying to accomplish?
It's an interesting debate. And I remember when Lemonade said that, oh, 100 data points, 1 million data points, whatever that is. And they said they'll know how to, analyze risk better. Now, the problem with knowing risk is that it could, kind of paralyze you saying, okay, I'm not taking on these customers. Sure. We can't.
It will, but but by understanding risk more, as you segment it, it reduces your total addressable market because you're making a decision like, okay, everything below this line, we're not going to even go after.
You're right.
Whereas prior to that exercise, you would have gone after them.
Exactly. And that's the thing. At the end of the day, what do you do with that data? And I feel like for some companies that are desperate, you know how humans, we like to take risks, right? So we're going to say, you know what, let's eat it. Let's take that chance. We need to grow. Sure. And then you may lose your pants. That could happen or not, or you ride the wave. But I think, to me, especially with simple products, like when we shopped for our media liability, coverage, then some insurers didn't want to insure us because they thought we were, provocative. So I understand. And we had limited supply, not a problem. But for car insurance, the simple products and in somewhat degree, depends where you are, home insurance, I think it's going to create so much pressure on insurance companies because there are so many and someone is going to make a mistake. It's inevitable that someone is going to make a mistake. And at the end of the day, the distribution partner is going to say, well, I don't care. I mean, as you said, a broker will write any business.
Yeah.
They want to write business.
Exactly.
They don't care about. So it's going to put a lot of pressure. But I think at the end of the day, distribution will win because I don't think, especially when customers are not coming in knowingly like, oh boy, I'm going to make a claim. This is what I want. Everybody talks about insurance as a social good, right? I mean, Lemonade talks about it. So where's the social good? Help. Find a different model. I don't know, do a crowdfunding, 50% insured, 50% crowdfunding like they do in China. Maybe it could work. But I think, again, the distribution, they're going to win. And we know.
It worked for final expense.
It worked for final expense. Assurance like you and Lumico, if the amount of chargebacks that Lumico is dealing with is incredible, but they still work with them. You know what? Because they're happy to find a partner that can sell their product. So they move on.
I think that the bottom line here is, and we said this last time, and it's really important, even though not everybody agrees with us, you have to start with a product, and different product will lend to different tactics and strategies. And with that, you're going to determine, because not every product has the same risk exposure, but almost every product obviously is entirely dependent on distribution. Now let's figure out what's the right distribution, whether it's a partner like Revolut, whether it's still your friendly broker. Maybe it's Amazon.
Can I tell you my experience of having gone through this for 3 years and having spoken to capacity providers, distribution, VCs about this? And sometimes it makes me feel like I'm missing something. But to your point, Sheffy, it's balancing trade-offs. There's no perfect answer. They're just, Avi, I don't want to downplay distribution. I think distribution's critically important for all of it. I'm just, in the sequence of how do you strategize this through, I think depending on the product, depending on what you're trying to accomplish, often you have to start with the product itself. In other areas, I think you may want to start with the distribution and then work backwards to figure out what's the product. I think there are different ways to do that, but there's no perfect way. No. And I think the quicker we all realize that there's no winner take all here, the market is the exposure is more the exposures that we have are more than the GDPs. So they're definitely more than the investable, economics that could potentially exist. The market's bigger. It can't be a winner take all. The market's plenty
No.
big for everybody. So I think it's just critically important to decide, what are we trying to accomplish here? That's what makes Asaf's commentaries just so important, because as I was questioning him, I was assuming that he was going to pick up his model and say, yeah, we're going to do auto, and we're going to do umbrella, and we're going to do, life, and, no, he knows exactly who his customer is and how he's going at it. That's the most impressive thing about what I heard, because it's like he's taking the risk. Like, he knows I am going to put blinders on and just really focus my opportunity costs. And I think that's where I think part of the execution fails, and is failing for a lot of insurtechs, is they're not connecting enough of the dots there. So the strategy has too many holes in it. And I think they're trying to satisfy too many stakeholders. Like, the VCs want the big, moonshot type of thing. But in order to get that, you have to sacrifice a whole bunch of other stuff, and nobody wants to sacrifice anything. And you get stuck. Like, you're doing too many things. And that's why, I think the models that execute, you can sort of look in and say, these companies are laser beaming in to specifically who their customers are and how they can serve them.
It could also be another, like a plain strategy, just like Lemonade did, where all these years and how fast they were, and they still stuck with renters insurance. I feel like they did that to come in for an IPO, say, but look at the potential. We're just getting started, So I think that could be also a good play for Asaf to say, look, maybe I'll go into car insurance, maybe I'll go into life insurance. And that would be a big selling point for, if they go for an IPO.
Wouldn't you say, though, that Lemonade knows who their customer, like their target customer is?
Oh, they know. They know, but you know what? I'll give you the other example. So I was talking to a former employee of, very big consumer-facing life insurance brand. I wouldn't call them a brand, but okay. And their investors came to them and said, look, this is not working. Life insurance is not working. Go into Medicare, go into auto, do everything. So some investors are saying, take off the blinders. Let's look sideways. Let's diversify. So I guess everybody has a different approach. I mean, if really Hippo is doing it to be laser focused and try to get it right, and they come then and say, we have a better loss ratio, better customer acquisition strategy, that's a big deal if they can come and show that. But the easy thing to do, like when something is not working, is to look at other places. That's the easy thing. You look at other places, and that is, as you said, it's a trade-off. Like, right, maybe you'll get it right, maybe it'll be huge all of a sudden, but maybe not. Maybe you'll make a mistake and you'll run too thin and you'll go bust. But it's an interesting debate.
Yeah, I almost think that it's a kind of like a mini game of chess, right? So it's something to the effect of, I'll hypothesize, imagine myself like in an insurtech that's bearing risk, and the loss ratios aren't good. We'll say that, there are traditional strategies to potentially lower those loss ratios. And I think what I liked about Hippo is that there's there's probably some lower bound that we're going to be able to get these loss ratios to. And it's like, what else can we provide? Let's think outside the box and think of, are there other non-insurance ways we can drive down these loss ratios? Oh, and are there other ways we can service the customer at the same time and generate another form of revenue? That is more strategic. Like, there seems like there's a strategy of moves here where, yeah, things are going to fail, but you can do the appropriate testing to experiment, to see what's working and what's not working. Give yourself enough time. And I think with a lot of these other insurtechs, they don't have that strategy in place. It's if the first thing fails, they're dead, you know.
Well, yeah, I
And
mean, not everybody raises hundreds of millions. That's the problem. Like, you need, a lot of money. Not everybody could do what Hippo or Lemonade or Root, because they don't have the resources. But
And
yeah,
there's another element here because Hippo's ecosystem of smart home players allow it to play in the cheaper side of the smart home and still use that as a great marketing and positioning and everything. I mean, he said he's not sure if he leads with that, but his website certainly leads with smart home insurance.
yeah.
So
and
it
they're
is
looking
a
for a
question of capability.
marketer. Yeah, they're looking for a marketer that will actually be dedicated to that segment. So, it is a differentiator because, other insurance companies are not leading with that. But
Well,
yeah, I mean,
so let me throw this out this way, right? Um, for what I do day to day, are there things that we do or that like I've suggested, right, that we do, where I'm not sure of whether this is going to move the needle for like financial results, but there's a second order or a third order of thinking here because I'm you can use like so Hippo uses the smart home. Smart home may or may not drive down the loss ratio, right? But Sheffy, to your point, it's a marketing tool. There's
yeah.
a there's an added element to that you can leverage. And that's where I'm sort of going with the strategy is that like day to day we test stuff too that we're not sure going to move that's going to move the needle, but what it does is for like our stakeholders, it gives them a sense of comfort that one, we're constantly experimenting, right? And where they can see that we have a committed focus to trying to figure out how can we improve our loss ratio? How
Yep.
can we do that? And it might be another source of data, it might be something else, but we're constantly experimenting with it. And I would say most of the time, I'm indifferent. Like I just don't think this is going to move the needle a lot. But if you string together all of those experiments, what I found is that it's made us a better company. All of them, like
Yeah,
those, even the failures stack on top of each other, and we're better off even with those piles of failures.
And just I'll add one last point. You talk about strategy, and um, if whoever's listening, Google the McKinsey documents in reference to Allstate. I don't know if you know the story, but read that as a strategy, how to be a better company in terms of profits. Whether or not the company actually adopted this approach is still debatable. But the McKinsey documents in reference to Allstate, a fascinating story
Is
of,
that available?
yeah, that's available.
Can you find that? Can we put that on the show notes?
I think I find a link, and I think I can find a
If
link
you can,
somewhere there.
so for those that
Yeah,
are listening, we'll research into that, find that, and we'll
yeah.
tag that to the show notes.
So yeah, yeah.
Yeah, because
It's
I would
just
I would like to read that.
yeah. It's amazing story. Really amazing story.
Okay, so um, this was supposed to be a 3 topic episode, but I think we did one because that one was plenty to talk about the hottest topic of the week, but also go into tangents into other things that were very important. So again, this stuff doesn't end. It feels in some ways like we're talking about the same thing over and over and over. But one, I think those topics are just so important. But there's always a twist to it. Like this one's the fintech element that's coming in, and I think folks that will think about this deeply, I think will see that there are patterns emerging here. And just stay tuned. That's all I can say. What do you guys say?
well, I think there's nothing new under the sun. So you're always going to be talking about the same things, but what we aren't talking in terms of the same context is just different companies. So
Yeah.
you've got, in terms of blurred lines, right? A lot of people eyeing insurance, that's the opportunity. Vice versa, you can go beyond. And maybe just a shout out to State Farm, who launched Sundial Labs, and it's basically a different brand entity under the State Farm umbrella of companies, and their goal now is to focus on seniors in the connected home space, so monitoring seniors. And it's a subscription product, so they can make revenue outside of insurance. And we always talk about going beyond insurance, or just giving credit to those that do very early on. I mean, right now they're in the introduction phase of where there's actually a promotion going on, so different pricing. But this is very nice, because typically when Avi and I read about seniors in the context of insurance, it tends to take the negative aspect, and this is a positive. So
Yeah.
to end on a positive note,
Yeah,
State Farm, go.
I think it's all positive. I remember in the early days, I was talking to Sheffy about Coverager and said, oh boy, what's going to happen when all these like other companies are going to enter insurance? There's not going to be any more InsurTech, or, we're going to see the companies are going to disappear. But it's actually very interesting. Just this week, we saw that Rivian, the electric car company, they've hired a new person to build their agency. So in a way, I feel like InsurTech 2.0 is just getting started.
Yep.
And the question is now, do you still want to dedicate yourself to InsurTech? Because if so, you know where you need to look. But if not, you look at State Farm and you look at other companies really going beyond, then, the world is open. You can do so many things. And, you don't just have to be in insurance. That's, I think, like the ultimate takeaway. At the end of the day, you're a company, you're in the business of making money, and there are different ways to make money, and models change. Models change all the time, and you just, as Sheffy says, be on your toes.
Be on your toes. That's a good way to end. So, Sheffy, Avi, thank you.
Thank you, everybody.
And for everyone that's listening, still stay safe. Try to, at least. And have an awesome weekend. And Sheffy, Avi, have an awesome weekend.
You too.
You too.
Okay. Bye, everyone.
Bye-bye.